All right, here we go. We are back. Juliet, Alex, great to see you guys. How you doing?
Great to see you. We're good.
Yeah, we have so much to talk about. We're talking about how we have to get so well prepared for these things now because there's just headline after headline and drama and updates and all these things. And it's been a really interesting. So we're going to go over, of course, Q4 and a full year of 2025 earnings. So there tells a lot of different stories. I think there's an acceleration of evolution, I would say, in the industry. So almost like a dumbbell effect that's happening, or bifurcation is a fancy word for it. Premium seems to be winning. Value is winning. Everything in between is either fighting for relevance or renegotiating with its franchisees. We have 5 earnings reports today, as usual. We have a $7.5 billion industry merger, which we can get into and I can talk about intimately. And then a surprise IPO filing. And the K-shaped economy seems to be finally showing up in gym memberships. So we'll dig into that and more. But first of all, how you guys been? What's new?
Well, yeah, we were lucky enough to go on a ski, as we talked about, to a ski trip to Japan. And the routine is you ski, you onsen, you eat ramen or sushi, and then you rinse and repeat each day. And it's hard to believe, and I would also say that what I learned, and granted I'm coming from the West Coast, but I can actually fly to Japan and spend a week skiing there for less than I could spend a week in Park City or Big Sky or, any kind of travel skiing for me in the US. I could do just financially the same flying to Japan, which is pretty crazy.
It's cool. I'm so glad you enjoyed Japan. And I'm, like I was telling you, I'm going to be going next February for my 50th birthday, and I guess I'll be a senior
senior discount.
That's great. And I'm going to get a lot of intel and beta from you guys because I'm sure it's you guys had a great time. Alex, what's new with you, sir?
Well, if you do go, I would say try to go to some sumo wrestling. That is just so interesting and such a Japanese tradition. You really do get an insight into the culture that I felt like I didn't get anywhere else. And then the onsen, are the spas that they have around the resorts, are just world class, and all the hotels have them. And yeah, it's an amazing spot. Yeah, I mean, I'm not going to whine about the snow conditions because that's pretty much what everybody's been doing for the last 4 months. Yeah, it's been a fun winter. I'm working on a project here in Jackson, a podcast that has nothing to do with fitness. It is focused on local entrepreneurs and founders and execs who run businesses in a mountain town, which is incredibly difficult. But there are a lot of great businesses around here, and I feel like they need a little bit more focus on them and a little more spotlight on them. So that's been a fun project.
Yeah, that's a great
to check
project.
It out, Alex.
Yeah. Does it is it launched? Is it published yet, or are you still working on it?
No, I'm doing 5 episodes, and they'll all get edited and then aired on the local community radio station, KHOL.
That's great.
89.1. Shout out to them.
Yeah, that's great. I love local. It's really cool. So if you guys ever expand to other mountain towns, let me know. We have a lot of really strong entrepreneurial folks up here in Whitefish too. So that's really cool. Good for you, Alex.
If it works here, I'd love to take it elsewhere.
Cool.
Yeah.
Awesome. Great idea, awesome. Alex. That's going to be really cool.
Thanks.
Well, okay. So let's get into it. We'll get into our quarterly reports. We have Lifetime, always leads us off, and then we'll get into Xponential, Planet Fitness, Peloton Interactive, and then Garmin. And so Lifetime, I'll just open with this. So premium big box is showing its pricing power for sure. And the numbers finally have Wall Street's attention. I'm curious to get your thoughts on that, Alex, in a minute. So here's some high level performance for them. So fiscal year 2025 revenue was 2.995 billion. So that's up 14.3%. They had an adjusted EBITDA of 825 million. That's up 21.9%. And the net income was 373.7 million, which was up 139%. Average revenue per member, which I think is probably the biggest story here, but I want to get your guys' opinions on that, is 3,531 per year. That's 11.7% increase. They raised their dues $10 to $30 per member with zero member attrition. I don't know how that could be true. That's impressive. Membership remained relatively flat, so 822,000 members. That's up 1.3%. So the growth is really about yield per head, not necessarily head count, and net leverage down to 1.6x and 2.3x, 823 million liquidity, 500 million share repurchase authorized as well. In their guidance for this year, 2026, they say revenue is going to be 3.3 billion. So that's up 10.7%. Adjusted EBITDA, 910 to 925 million, and 12 to 14 new clubs. CEO Bahram Akradi says nearly all of next year's planned 12 to 14 new clubs are currently under construction. The demand for Lifetime continues to grow across all markets. So much to talk about. Where would you guys like to start?
Well, I mean, I went on a deep dive on the K-shaped market, which was a term I was not familiar with before. And to me, when I saw all of these companies under that lens, it made so much sense to me. I sort of feel like we've lumped all these companies in this like fitness market category, but really, I don't even know if they should even be lumped together, right? Like I feel like we have premium fitness, we've got Planet Fitness, and then we have this sort of jumble in the middle. So I just loved, for me, that framing of this, not just Lifetime being at the upper part of the K-shaped market, but framing for the whole conversation, because I wasn't even familiar with the K-shaped market idea until this podcast. So that was my big initial overarching takeaway. I'm sure you know all about the K-shaped market, Alex, but I was new to me.
Well, it's pretty new to me. I think that with, macro, with income disparity becoming more and more pronounced, I guess, the macro thinkers are looking at different industries and saying, okay, where are the affluent people going in the fitness industry? And they're going to Lifetime Fitness, and how is that doing versus the more low-priced providers like Planet Fitness? And there's a divergence, right? The Planet Fitness stock, just looking at the stocks, Planet Fitness is down about 16% in the past year, and Lifetime is not doing great either, but still relatively flat. And in terms of growth in 26, Lifetime is expecting to grow faster than Planet. So, I wonder if that's just confirmation bias. Somebody has a theory and they're looking around and trying to, find examples of things that confirm it. But, Lifetime is definitely performing the best in the universe that we're looking at. And I would point out a couple things about their, the recent earnings call and the quarter. The $500 million share repurchase is big news to me because they've never done it before. And what happens is they allocate capital to buying back their own stock, which is a way of returning capital to shareholders. It's sort of a way of benefiting shareholders when a company is doing well. And they've never done it before. They've always taken all their capital and reinvested it in growth. Planet Fitness, on the other hand, has been doing stock buybacks for a long time. And, I've been complaining a little bit on some posts and maybe on this podcast that Lifetime is a great company for members. It's a really good company for, I think employees. I think they pay them well, they treat them well. I think the executives have done well, but shareholders have not done that well. So this is an opportunity for them to say, okay, we're going to prioritize the shareholders a little bit more. And if you want to sell your stock, potentially the company will allocate capital to buy it back. We'll see what they actually do, because the fact that they've said, okay, we have 500 million that we're going to allocate to buybacks doesn't mean they're actually going to do it. And it doesn't mean they're going to do it within a year or 6 months or 18 months, so we'll see. I mean, the other thing that jumps out at me is that their capital expenditure is going to be over $1 billion in 2026. They've never gone above $1 billion as far as I know. So, at some point I get a little concerned that that's just spending too much money.
Yeah, I mean, I have a question for you, Alex, and a point to make, but I always, it's amazing to watch because clearly they're doing well with this model of just getting each one of their members to spend more, which is amazing. I mean, honestly, $3,500 per members, like that really stood out to me. That's a lot of money for, average people to be spending on a gym membership. But at some point, especially spending all this money on building new clubs, they do need to also start increasing their member numbers, I assume. It has to be and, not an or. And right now it seems to be an and. And then my question for you, Alex, and I just might ask this every single podcast because I was looking at the stock and I was like, it's like, flat to down. And like, I guess I never understand still why Wall Street doesn't like them and fitness companies. And part of me is like, is it because Wall Street sees them as just like a gym? Versus what I think they're trying to reposition themselves as is like a premium wellness facility, right? Like, is there something in the perception of like, it's bucketed in with like a Planet Fitness. And so that gives off this impression we're just talking about a gym versus what they're really doing is like so much more than a gym. In fact, they're probably making more of their money from other things that aren't the gym. So I don't know. What's your take? I mean, I think I ask you this question every time because I'm always like, why?
Yeah, why?
Yeah, I mean, I think it comes back to, what I was saying before. Are they prioritizing shareholder returns or are they really prioritizing growth and, member experience? And which I mean, I would never fault prioritizing member experience. I would never criticize that. I think the amount of capital they're putting into growth would question. You want to grow 12 to 14 clubs, you want to spend $1 billion a year. Is that ego? Is that like building monuments to myself at some point? Is it really, why does it have to be 12 or 14? Why can't it be 6 and why can't you spend 500 million instead of $1 billion and start paying dividends to your shareholders, for example? Increase the buybacks, try to push that stock. The analysts think the stock should be worth $35 to $40. It's stuck in the mid 20s. This is an issue that a lot of companies have faced that are public, and even Apple, at one point they weren't paying dividends and they weren't doing buybacks, and shareholders were like, you got so much money, so much cash, why don't you return some of it to shareholders? So I think that's what it is, Juliet. I don't think anybody disagrees that they know what they're doing with their investments, but why does it have to be $1 billion? Why can't it be 500 million?
I think that makes a lot of sense.
Yeah, it does. And that was the exact same question as why they Wall Street keep punishing these guys. It's an interesting thing. So, well, any other last thoughts on Lifetime? I mean, they just keep they just keep catering to that high end consumer. They get them to spend more, and it seems to be winning, at least in the short term. So
yeah, strategy is good, and I would say the management is really stable, which I'd love to see.
Yeah. Right on. Okay, so Xponential Fitness. The franchise model is under a little bit of stress. It's real stress, you guys. System-wide sales are growing, but the unit economics don't seem to add up everywhere. So high-level performance for Expo. Fiscal year 2025 revenue is $314 million. That's down 2%. Adjusted EBITDA, $111 million. That's down 4%. Net loss, $53.7 million. North American system-wide sales was $1.7 billion, so that's up 13%. And the growth was driven primarily by new studio openings, not same-store performance. Q4 same-store sales, negative 4%. Q4 adjusted EBITDA, $22.9 million versus $30.8 million the prior year. So that's down 26%. Legal exposure, well, sure we'll get into this. 17 million FTC settlement pending and 22.75 million franchisee class action. 2026 outlook, revenue 260 to 270 million. So that's down 16% projected. Adjusted EBITDA 100 to 110 million and 150 to 170 net new openings. Mark Grabowski, the CEO, we are committed to returning the business to sustainable, profitable growth through focused execution and strengthening our franchise relationships. And there's a lot going on here. So there's some activist pressure we can talk about. FTC settlement. You sent us a screenshot a few weeks ago, Alex, when their stock tanked. It was a brutal day.
Yep.
And I think we aligned that with basically the FTC announcement, a couple other things, right? So there's a lot going on. Alex, you want to kick us off? What are you thinking here for Expo?
Boy, well,
that says it all right there, Alex.
Yeah, I mean, stock's down about 50% over the last 12 months, and they can't get a break. I mean, not that it's not self-inflicted to some degree, but the settlements that cost them, I think 40 or 50 million in cash. That's actually, it's a lot of money. Obviously, that is legacy that I feel like the current management inherited from prior history. And so you can't blame the current folks for all the questionable practices, I guess, that the government has uncovered and that franchisees have been damaged by. So, part of that money is going to franchisees who felt they were misled. And then I think part of it's going to penalties to the government for franchise, I don't think they've admitted any guilt, but they've agreed to pay $17 million. So obviously there's something going on there. So I think the company is so dependent on Club Pilates.
Mm-hmm.
That is the crown jewel. That's where the cash, I think over 100 million of EBITDA comes out of that system. And the Pilates, I don't know. I mean, what do you guys think? Is it based on the numbers, it looks like those studios are declining a bit in terms of revenue. So is there just have we reached the saturation point for that modality? And if that's your crown jewel and it's not really growing, at least not the mature units, how it's a healthy business, but it may not be a growth business anymore. So that's a challenge for them. The activist investor
Voss.
They own 20% of the business of the stock, and I think they've been investing over the past few years, so they're sitting on a pretty big loss. It sounds like they want to force a sale, I think, a go private. So I think that, in the future, we may not have numbers from Expo if they do go private.
Yeah.
Unfortunately. But, the activist makes a good point. The Club Pilates franchise is worth a lot of money. I think if they're doing 100 million of EBITDA and it's a 10 multiple or something like that. It's $1 billion value. Right now, Expo's market cap is, I want to say, 300 million. So, they could just the point the activist is making is that the Wall Street doesn't value the company based on Club Pilates. They value it based on the portfolio, and the portfolio is 5 brands, of which one is really profitable and the others not so much. So I think it's a go private. It'll go private at some point. I wouldn't be surprised. That's what happened with the stock was it dropped, and then after the earnings reports where Club Pilates was shrinking, the overall revenue for 26 is expected to shrink. So Wall Street was like, this looks like a falling knife or something, and we don't want to be in here. But as soon as Voss said, okay, this should go private, and the value is a lot more than the market says it is right now. The stock popped up significantly, like 40% or something. So what do you guys, I mean, do you think we're at peak Pilates and we're saturated and that's pretty much, plateaued?
Yeah. Do you want to go, Eric, or I can
Yeah,
go?
so I think it must. So I had an interview that I published just about a month ago with Anthony Geisler, so the former CEO and founder of Expo, and he's on a Sequel Brands now. And one of the things I did ask him was like, is there anything that you feel like you learned that you can now apply to Sequel? And the first thing that came out of his mouth, and maybe the only thing, was like, I wouldn't go public. It just blah. I wouldn't go public. We're never going public, right? So I think that comes with a whole, that's a major learning process of what it takes. And that's just the maturation of our industry too. We just don't have a lot of public companies, right? There's not a lot of templates that you can look at, but their big flagship that they're hoping to be their flagship is the Pilates Addiction franchise. So he's expecting by the end of the year 200 units sold. And I don't know, I can't remember how many openings that is specifically. So they're betting that it's still wide open. I just can't see the growth happening forever. I mean, how many Pilates places we've been around long enough to see these cycles of different things come and go, right? But I think you had stated this last time, Alex, is like great operators will do a great job and they'll be successful as long as they operate according to their standards. And but I just can't see it. I think most of the time, and I've heard mixed things too, like Pilates is flattening out, but people are still making big bets there. And you even look at like a Legree Fitness, like what he's doing, he's booming right now. He's going global and he's doubling down on everything. And so there's a lot of players who've been around Pilates for a long time that are now reaping a lot of those rewards. But I just don't see it possible. What do you think, Juliet?
Yeah, I agree. I mean, I think there is a there. Like, it's not going away. I don't think it's a fad. But as a single, I especially feel like in a weird macroeconomic climate, as a single modality, like to me, Pilates is something you do like in addition once or twice a week. And I do know a few people who like the only thing they do is Pilates, but I just don't think it's just the thing. I think it's always going to be an extra that you do in addition to an actual, like fitness program. And so I think that's going to be the first thing, especially in a weird macroeconomic climate, that like people will cut out. Classes are expensive. You're usually buying them on a one-off. Some people have a membership, but I don't know. I guess I feel like, man, even where I live, there are Pilates studios on every corner. And
yeah, same here.
I feel like it's not going to go away, but I just can't see massive growth in Pilates. There are so many Pilates studios out there.
You start to see these trends too. Like I feel that when health clubs start to integrate certain modalities, like when spin went into health clubs, right? You kind of saw this batch, it just flattened out and now it's pervasive, right? And what we're seeing now is Crunch, CR Fitness is opening their first Pilates studios inside of a Crunch Fitness in Texas. And I'm like, oh, it's happening. It's happening now, right? Reformers, no additional charge. It's just part of your membership. I'm like, okay, well, that's to me is a really big sign.
That happened to CrossFit too, right? Like big gyms all of a sudden started having Rogue fitness equipment and a place where you could Olympic lift and, kind of like functional fitness. They were like getting rid of racquetball courts and making functional fitness areas, right? Like once those modalities get subsumed by big clubs, I think sometimes people are like, okay, why would I go here and pay $30 per class when I could just loop that into my membership? So yeah, I see that. I think the other thing I wondered when I saw all this Expo stuff is this model of like the conglomerate model, does it make sense ever, right? Like obviously they're the only public company, but there's FitLab and a few others who are trying to conglomerate these fitness companies. And FitLab has kind of to me, sort of a random group of, sub brands. And, is this a model that can work? I mean, it doesn't seem to be going that well, obviously, for Expo. And I don't know if the problems are because it's a public company, but I don't know. Do you think there's room for this kind of model at all, Alex, or either one of you? Like, is this a thing?
I mean, I like the idea of having a portfolio so that, as trends emerge, and cycle up and down and popularity waxes and wanes, you always have a modality that is on the upswing. And you're sort of, it's a portfolio theory, right? So the challenge is that you have to pick really carefully and really well. And, arguably Expo has, they picked really well with Club Pilates, but, cycle bar and the rowing modality and the running modality, and they had a lot of strikes, a lot of misses, and so basically it's sort of, it looks to be a one modality company right now, and I mean, if Yoga 6 or Stretch Lab had really sustained, I think Yoga 6 probably stable, not really growing, but stable. Stretch Lab had been on the ascendancy for a while, and then it kind of lost its mojo, and now it's a liability. So I think a portfolio is great if your batting average is higher than theirs has been.
Well, I think to that point too, I think it's a great theory if you're actively divesting and investing, but I just haven't seen them do a lot of that. I haven't seen a lot of turnover in their brands, updating brands. I mean, they still have, Stride, but now it's running plus fitness, plus strength, right? It's like how they're rebranding. It's like, well, I think it's too late. I just do. I think it's too late. I feel like it's in the name, right? It's in the name. And yeah, but I think it can work, but I feel like it needs to be more fluid in the amount, but I don't know. I don't know how difficult it is to invest and divest in brands. I could be completely talking out of the side of my face here, but that's what it seems like to me from an outsider perspective on the industry.
Yeah. Well,
we'll see.
I don't know that we'll be talking about them much for many more.
Yeah. There seems to be a pretty strong sentiment from the people that matter within their structure that they won't be public too much longer. So let's see. Let's move on to Planet Fitness. So Planet is playing offense. 20.8 million members in a down macro says more about brand trust than any earning metrics. So let's talk about some high level performance here. So full year 2025 revenue, 1.324 billion. So that's up 12%. Adjusted EBITDA, 550 million. That's up 13%. Net income, 220 million. They have 20.8 million members. That's amazing.
Every time that blows my mind.
It's so many. Their first full year after 50% increase hike for the new Classic Card members, demand barely flinched. So that's a really good sign for them. And then we'll talk about price elasticity, I'm sure. But system-wide same club sales was up 6.7% fiscal year, and 2,896 total clubs, which was opening 181 new ones in 2025. Equipment revenue, which I'm curious to get your guys' take on this, was up 21.1%. Cash position, they have 607 million. No near-term debt pressure really. And their 2026 guidance is revenue up 9%, same club sales up 4.5% or 5%. Adjusted EBITDA up 10%, and Black Card price increased summer 2026. So a lot to go on this year. And the CEO quote, Colleen Keating says, adding approximately 1.1 million of net new members in 2025, the first full year of our 50% price increase for new Classic Card members, highlights the incredible demand for our brand. Okay, where do we want to start? Juliet?
I mean, I'll just start by saying I continue to be, I'm amazed by this company. I think it's amazing that they were able to both raise prices that much and continue to grow their membership. Especially after watching Lifetime has, they're focusing on something completely else, but not raising their number of members. So I thought that was interesting. I do think, as I thought through this whole thing with the lens of K-shaped economy, and to the extent that the macroeconomic, I'm assuming the reason Wall Street does not favor Planet Fitness is that they think that their consumers are more likely to be impacted by, negative macroeconomic trends. And so they're always just sort of like, oh, we don't know about this business model because, if the economy starts to go south, like, Planet Fitness is going to be the first company to take a hit because those consumers are going to be so much more price sensitive than a Lifetime or even Peloton or any of the other brands we talk about. So still amazed, but I guess I see in the larger economic climate why Wall Street doesn't reward this company for all their awesome work.
Yeah. They kind of made a mistake, I think. They had an analyst day last year, and they showed what they expected the business to do over the next 3 years. And the the growth rate in revenue was expected to be around 15% a year. Now, you don't have to have analyst days where you talk about the next 3 years. Companies sometimes do that. Not every company does it, but it's a risky proposition. So basically, they have their analyst day in the fall. They say we're gonna grow at about 15% a year for the next 3 years, and then in February they have an earnings call where they say, well, we're just gonna grow about 9% in the first year of our 3 year period. And Wall Street's like, well, we put out all these reports saying you were going to do this, and our stock price projection was based on that, and now you're not. Now you're disappointing already. And then management starts talking about snowstorms in January, and some other things that justify the lower projection, the guidance for 2026. And so the analysts are spooked, and the Wall Street spooked. They don't know what's going on. They're worried that there may be some underlying issues that they don't understand. Is HVLP too competitive? Is it with Crunch and EOS and all the others having sold last year, and now they have hundreds of millions of dollars to invest in new units? Is it as with Pilates? Is it just too saturated, or is it plateauing? The other thing that Planet Fitness did that was a little bit controversial was they adopted the click to cancel. So it's become really easy to cancel your membership there, and that goes against what the industry typically believes, which is you got to make it a little bit stickier than that, a little harder to cancel. And so, is attrition a problem? And did they make a mistake by adopting click to cancel? I mean, I think it's the right way. It's the right way to treat your members. You should not have to send a certified letter to the corporate office for your membership. That's just like so antiquated and anti-consumer. But anyway, so I think that's my, I think that's what happened here. The underlying business, I think, is still I mean, it obviously is still performing, and 4 to 5% same store growth is still very good. So it could be overreaction.
Do you think, Alex, there's any space for anyone not to be click to cancel anymore? I mean, I feel like we're all overcome by thousands of subscriptions and always trying to cancel and manage. I've even noticed now, like on my credit card statement, like I can go on to my credit card and just say, this is a subscription. Like one of the options is this is like for a charge is this is a subscription I canceled, and like my credit card will automatically refund me in 2 seconds. So it seems like there's just this pressure now to make it real easy for people to cancel. Otherwise, you're
subscription.
I don't know. So I don't know what does Lifetime do? What are other gyms doing? I'm assuming Peloton is click to cancel because it's just, it's an app, but I can't imagine there's much interest anymore in anything up. Like I can't see how you can not have that click to cancel. Like who's doing that?
The industry resisted the click to cancel rule and objected to it. And I would be surprised if a majority of clubs have adopted click to cancel, because they don't have to. And I think a lot of them think it's against their economic interests. So I don't know. I don't think Lifetime has click to cancel. I don't think Equinox does. But I haven't checked it. But I know that the majority opinion in the industry is that click to cancel is not appropriate for health club members.
Interesting. What do you, when it says equipment revenue up 21%, what does that mean?
So they basically sell equipment to franchisees.
Okay.
If you have a Planet Fitness franchise, you buy your equipment from the corporate office, from the franchisor, and they mark it up and make a profit.
Nice. Yeah. Well, we'll see. We'll see what happens this year. It's you know, they're a big player in the industry, and they're doing a lot of things right. But that is noticeable, is like the analysts seem to be a little shy of what they're doing, and downgrading them a little bit as far as their growth this year. So it's interesting. Any last thoughts on Planet? All right, let's go to Peloton. So Peloton's profitability pivot is real, but subscribers keep leaving, and that's the number that matters most long term. Some high level performance numbers here. Q2 2026 revenue $656.5 million. That's down 3%. Sorry, that's full year 2026. Gross margin 50.5%. That's up 320 bips. Adjusted EBITDA $81.4 million. That's plus 39%. So net loss $38.85 million versus $92 million the prior year. So the losses are narrowing fast. That's good. Net debt down 52% year over year to 319 million. Paid connected fitness subscriptions 2.661 million. That's down for 7% year over year, down minus 214K. So churn 1.9%. I don't know. So Peloton IQ, that's their AI personalization rolled out to all members. That seems to be kind of part of the game now for everybody. Nearly half of active members engaged within the first quarter. I'd be curious to see what it was the second quarter, or what it will be second quarter. And full year 2026 guidance, revenue 2.4 to 2.4 billion, saying down 3%. Adjusted EBITDA 450 million, up 18%. And the CEO quote from Peter Stern: "Our second quarter represented the most substantial period of innovation at Peloton since our founding. We're proving we can simultaneously innovate and increase our profitability." So Peloton, sticking around, iconic brand, trying to figure it out. What do you guys think? Juliet?
To me, I feel like they are starting to maybe show that there's hope they can be a healthier business. Like the way that I thought about it was like, especially in terms of the way Wall Street's viewing them, they're like cautiously optimistic. They're sort of like still sitting in the penalty box though. And I was particularly interested in the AI piece that you mentioned it, but that half their members were engaging with the AI agents. Because I don't know about you, but I'm just so curious. There, we have Future and Ladder, and we're working with another company called Farron, and there's so many. I'm so curious to see if this is how people want to consume their coaching and fitness, or whether ultimately they're going to want to go back to, a more in real life model, whether that's not really going to work for them. So I don't know. I mean, I thought it was interesting that people, like half of them engaged in it. But is that because it's a novelty, or does that have staying power? Is that how they're going to want to continue to engage with their health and fitness journey? But I'm also curious, because is it possible that you can get something that ultimately feels so much more personalized, based on your data and your history and what's going on in your life, that people will really enjoy it? So I don't know. To me, that was an interesting insight, and I really want to see what happens with that going forward, like to see if it's a novelty or whether people really use it. I don't know what their AI agent does. Like, I just don't. Is it just a support agent at this point that you can engage with? So who knows? But to me, that's interesting. They obviously have the resources and technology to be able to deploy that in a gigantic scale, and will be really interesting to see if consumers want to consume their fitness content that way, their programming and coaching. I don't know. What do you guys think?
I mean, I'll chime in on that. I think that I've been following a lot of the AI. Everyone has an AI coach that they're developing at this point. And I think there is a distinct advantage of having the AI directly associated with the hardware. I think everyone has an app. No one really wants to have a random training app that does everything. I think like eGym's a great example of like, their AI is built into the hardware experience. And I think that's what a lot of people want. Or it gives them a greater opportunity for success, because you go to the machine, it remembers you, maybe gives you a few things. It's like, it's there, right? It's just in the experience, it's baked in. But I don't know how it's all going to plan out. I mean, I think there's already seeing a lot of technological fatigue from people, consumers. But it is an interesting point, I thought too, just they're going towards this wellness play. And I just don't get it. I don't know what I'm missing. but I just, they're an exercise bike, right? They're a great piece of cardio machines. And so the wellness play I'm just not getting. But yeah, Alex, what's your take here?
Right.
That
Well,
face says it all too.
Yeah, exactly. I was like, we just know by Alex and I, we're like, nope, it's not going well.
Well, I don't want to be totally focused on the stock price, but down 33% over the past 12 months. If you look big picture at what's going on there, the subscription level connected subs, so connected subscribers in 2026 is about where it was in 2021 at this point. They used to have 8,700 employees. They currently have 2,400 employees. I mean, that's just a dramatic change, right? I don't know many companies that have gone from 9,000 to 2,000 employees over 5 years that have, survived. But that being said, the EBITDA is improving. Right, the dropout, the attrition rate is low at 1.9% that's per month. It's 24% roughly over 12 months. So they're losing a quarter of their people. But if they keep losing 8% of their subs a year, where are they in 5 years? I mean, that's, they can raise prices a certain amount, but I'm not saying that's going to happen. If you're taking the bear case, you're like, okay, this is what they call a melting ice cube. It's only going one way, which is getting smaller and smaller. So, when a CFO leaves, like this Liz Coddington left, I think is leaving this month. She's been there 4 years. She's done a great job. But basically, and she probably has a lot of stock options. So she's kind of saying, yeah, I don't expect this to pay off. And I mean, that's just speculation. I don't. But when high level execs leave, I worry that they don't have confidence in the future. That's a concern. They have to figure out how to grow, right? And they just haven't figured it out. They had a bunch of product innovations in the fall that they were hoping would drive holiday sales. They disappointed on holiday sales. They did not hit the numbers they wanted to hit. So what does that tell you? I mean, they've spent about $1.5 billion over the last 5 years on research and development. Can you point to anything that they've done in terms of innovation that's really driven revenue? The rowing machine, the guide, the treadmill. It just, those things are really expensive to develop, and I just don't think the returns have been there on their R&D. I mean, I'm sure they haven't been there on their R&D. And if you spend $1.5 billion, you'd think you'd come up with a couple of hits, right? But it still is it's a bike company at the end of the day.
And it's just, to me, it seems like the amount of innovation one can do on a rowing machine, a treadmill, and a bike is not infinite.
Yeah, no.
And like, I go around all these gyms and use every one of those devices, and like the Concept 2 rower is hands down, like if you run into literally any other rower at a hotel gym or some connected gym, it sucks. So, people are innovating and not doing a great job. I don't know what Peloton has to show for it.
It's just a matter of like, have we, just with the advancement of this is what I think about, is the advancement of technology, has the connected experience kind of already gone past us? Like, it was a really special place in time, everyone was essentially stuck at home, and it was a cool experience, but we're moving so quickly that consumer expectations are moving, like they want something better now. They want something more interactive. They want in real life, right? It's just like it just seems to have had a moment in time that was very special, and it's hard to build upon that because it just doesn't exist anymore. And the commercial B2B side, the Pro Series, seems to be growing in double digits. So hotels, corporate wellness, military. But the big question there is like, how far can that go without cannibalizing the consumer aspect of it? And then do they even care if it's growing? It's growing, right? So I don't know. There's certain signs here, but I just wonder, like, when do they get acquired? By someone.
Yeah. Well, it's another one where they could go private.
Yeah.
And some private equity group could try to figure it out. And why could they combine with another company like Tonal? Would that make sense? And you get some synergies and some economies of scale in manufacturing and content production. And they seem like they're kind of addressing the same market. I don't know that that's a long-term solution to growth, but should they be in the wearable business? Should they be in the sleep business? What could they do? My assumption is my hope is that they will figure out how to grow again. And they have some time to do that because they do have, improving financials. Do they need, at this point, they continue to cut employees. I mean, they just cut, I want to say 11%, so 250, 300 people in January. They're down to, what did I say, 2,400 or so.
Yep.
Do they need 2,400 people to run this business? Do they need to spend $60 million a quarter on R&D? It's amazing how many times they've, restructured, and they don't seem to be at the done with the restructuring. The rifts just keep coming.
Yeah. One positive thing, though, I feel like we've talked about them every time, and I felt less so this time, is every time we've talked about them in the past, I feel like they were doing sort of a, just whack-a-mole strategy. Like they'd be like, we're in University of Michigan, and now we're renting our bikes, and now we're doing this. And I actually felt like this last quarter, there wasn't a lot of that noise this time, that maybe they were like, hey, we don't need to be doing ton of these little one-off random initiatives to see if they work. Like it seemed to me like they were, cutting people, cutting costs, trying to just focus on the membership piece. So I thought that was a good sign, because up until recently, that's what they've been doing, is like, we're partnering here, we're doing this. And I felt like there was less of that this time, which I thought was a good sign.
Yeah, I agree.
That's a good point. I like that.
All right. Let's go. Garmin's fitness engine is running at full speed, guys. They just raised the bar for what a wearable company can look like financially. And let's go over some high level performance here. 2025 revenue, $7.25 billion. That's up 15%. Operating income, 1.9 billion. That's up 18%. And operating margin, 25 or 26%. Fitness segment specifically was 2.36 billion. That is up 33%. Operating income, 726 million. That's up 50%. Margin, 31%. The clear earnings engine for the company. The fitness segment is crushing it. 2026 guidance revenue, 7.9 billion. Gross margin, 58.5%. And so CEO Cliff Pemble says, we are all positioned with a strong lineup of innovative products and a growing ecosystem of health and wellness services. I got to moderate a panel last month at the Connected Health and Fitness with Andy Beckerman was on it, and we talked a lot about data. And I just wanted to remind Andy, because I hope he's listening, that we love Garmin and we have sponsorship opportunities available. And as I told you on stage during the event, where do we want to start? I mean,
Shout
we love
out
it.
Andy. Shout out Andy.
Yeah, we love you, Andy. We love you, buddy.
Man, I mean, I just love this company, and I guess I still think it's sort of funny we talk about it, because it does sort of seem like public fitness adjacent, but it's just amazing to watch this company. And I feel like they've really sort of, like, they're not just a hardware brand though. I feel like they've like tapped into this like health performance identity, like people who want to have, health and performance be their overall identity. Seems like they're expanding into this healthcare thing with their TrueMed collaboration. Obviously they have this huge and expanding fitness market, but they still are doing all this other non-fitness stuff. So, I guess I feel like that like Garmin is doing what I think all these other companies we talk about want to be doing in fitness. And they aren't quite there yet. It's just this company continues to slay at every level, it seems to me.
Yeah. To carry on with the fitness too. So they're up 33% like we discussed, but outdoor was only up 5%, and auto OEM is still unprofitable. And, you got to wonder, is the fitness wearables boom, is it kind of masking some of the structural pressure in the other divisions, or, is the whole thing looking pretty healthy? Looking at the numbers from the Wall Street standpoint, Alex, what do you think?
Well, Wall Street was really happy. I mean, their stock is up 11% over the last year, which is good. I mean, it's not amazing, but it's really good. My question though is, who are they gaining market share? I got to believe they are. Versus who? Versus Apple, versus Whoop, versus Polar or Sunto, or because or are they tapping into a new market? Are they expanding the fitness wearables market, or are they taking market share? I don't know. That's a really interesting question to me, because if they're taking from other people, it's probably a combination of both. But if they're taking from others, that means that what they're offering is perceived as being better than what Apple is offering, or Whoop is offering. Or if they're expanding the market, then people are happy with their Apple Watches and their and their Whoops. But there are new people coming in who are saying, I want a fitness wearable. That means people are optimizing, I guess, and paying more attention to their data, and that's a real change. So I don't know. I don't know how you get 33% fit growth without taking market share from other people. But if we could figure that out, that'd be pretty cool.
I do think the identity piece is so important with Garmin, because I do feel like everybody I know that wears one, they're the people who care about tracking data. They sort of see themselves as an athlete, and that Garmin brand is really like the performance brand, and that's the identity piece that they care about. I also, speaking of market share, even though I'm covered in like 17 tracking devices, I do think, especially as people become more subscription aware, and they're having a Whoop and an Aura, and then realizing you can have a Garmin with most of those insights and then some. It's sort of like this is the boutique fitness company and this is Lifetime, right? Like that's how I see these things. And so at some point, you can get all this data, your sleep data, they've added nutrition, there's tons of data, plus you can use it to really clearly and probably the best track your workouts. The GPS is the best. It stays charged. So I just wonder if it's not just, to the extent that it might be taking market share, that it's not just taking market share from Apple, but from these other tracking devices. Because I will say, when I first started using my Garmin, I felt like, especially the sleep tracking feature was pretty inferior to Whoop or Aura, and now I feel like it is equal. And I wonder if it's not also stealing some market share from those companies, if it is.
Well, I just did a quick little query here on Claude, and so Morningstar confirmed that Garmin is gaining share. Their fitness segment grew 33%, as we said, market expanding at 18% annually, so they're outpacing the category by nearly double. The primary victims are Fitbit, Google. So they're down from 48 million to 48 to 42 million. So that was the big one. Apple seems to be untouchable still overall, but yeah, it does. It seems like they're eating away at the market segment.
Interesting.
That's a really good point about subscription. I never thought about that. Like I have subscriptions
like at
to
some
so
point
many
you're
things.
paying. Yeah, like at some point you're like, well, I could get this one watch with all this data and no subscription.
Yeah.
Or I have an Aura or Whoop, which I'm paying a recurring subscription, and we all have subscription fatigue. Yeah. That's a consideration.
Yeah. And the TrueMed integration too. I think, I don't know if we talked about that, but yeah, now they have HSA, FSA dollars. You can purchase that, which means that they're considered healthcare purchases, not necessarily consumer electronics. So that's an interesting evolution. I think that's something to make note of, because a lot of companies are going that way now too.
Yeah. We've been using TrueMed for, I don't know, since they very at the very outset of the company. Like I was like, I understand this. We should all be doing this in fitness. It makes sense. So it's cool to see they're doing it too.
Love Garmin. We love it. We just love Garmin. If we
Love
were going to
Garmin.
align with one brand here on this show, I feel like that
We
would
would
be
love
one.
them even more if they sponsored your
Yeah.
future of
It
fitness.
doesn't take much, really.
Shout out, Andy. Shout out.
Any last thoughts on Garmin, you guys? Get on to some industry news and transactions. So we talked about the K-shaped economy. Originally, you had sent that article out, Alex. So we could probably move on, but we can talk definitely about something that was probably one of the biggest news our industry's seen in decades, which is the Playlist and eGym merger. So now they're a $7.5 billion company. And, I was lucky enough, I emceed their kickoff event in Munich in January, and the event was the day after the announcement. So the energy was very high, and got to interview Fritz and Philip on stage and talk to them about all that was going on. And, obviously this is still needs regulation approval, right? Regulatory approval, but it's a big deal. And I mean, I have a lot of questions about it, but when you guys saw this, what was your first reaction?
You go ahead, Alex. You go ahead.
I think I posted on LinkedIn that it was a head scratcher to me. It wasn't something I expected to see, and I wasn't really sure how or why Playlist, ClassPass, MindBody wanted to be in the hardware business. Not that eGym is only hardware, they aren't. But I always look at sort of the org structure, and I try to read between the lines. I don't have any inside information, but it felt like the business was pretty much going to be run by ClassPass, and eGym was being subsumed. So not a merger of equals. And then what does that mean for the future of the hardware side of things? And does that get separated out at some point? So I don't have a lot of intel on it, but as an outside observer, I was kind of scratching my head and saying, this is not obvious to me that this is a merger that makes a lot of sense.
Yeah, I mean, all I have to add is I thought the exact same thing. Head scratcher. I didn't really get it. And then I didn't honestly try to get it that much because I was like, Eric is deep in this. And I knew you were doing the thing in Munich. And I was like, Eric is going to have insights on this because you have interviewed everybody and been deeply involved. So I'd punt it back to you, Eric.
Yeah. Yeah. Well, a lot of it is TBD because once, they're the major announcement, and then it's got to go, regulatory review, and then they'll start to have a clear idea and be able to unpack exactly what the plan is. So a lot of it's still hush hush. And, interesting fun fact too is Fritz Landman actually lives in Missoula, Montana. He's a big fly fisherman. That's how him and Philip got to know each other, as he invited him fly fishing. He also likes to ski. I just saw him a couple of weekends ago up here in Whitefish at the ski resort, the Summit House. So that was kind of fun. But here's the thing, and I've communicated this to people on both sides of eGym and Playlist, is that MindBody and ClassPass have kind of a complicated relationship with the operator community. I think ClassPass has revolutionized a lot of things, especially on the consumer side, but a lot of gym operators aren't huge fans. MindBody's been around for a very long time and has a lot of fans, also has a lot of operators who are frustrated with the platform. But then you got eGym. It's just like this rock star brand. They're kind of like the rock star of the industry, right? They're cool, they're hip, they're doing tech. They're like, what are they up to next? They're always doing cool releases and branding and all that stuff. And you're wondering, like, how are those going to mingle, right? How are those two things? Is one going to support the other? Is one going to not support the other? If you know what I mean? So I don't know. It's going to be interesting, but we just don't know yet. And of course, like one of the big drivers that doesn't get enough press behind this is WellPass and eGym's corporate wellness solution, which is a substantial chunk of business and growing really fast. So we'll see. We just don't know yet. I don't think they've given a lot to work with yet.
But all I can add is, as a former gym owner, we were not fans of ClassPass. I was like, why would I take $5 for a client that would pay me $30? Like they would come in, they would physically come in, and I'd be like, help me understand why I would do that. And they were never able to say the volume would outweigh the discount they'd be giving to people. So I honestly, as a gym member, I understood from a consumer standpoint, especially if you just want a boutique. For consumers, it's great. If you want to just hop around a boutique fitness, it's great. But for operators, it's terrible. So I never got it. I was never a fan.
Yeah, and then I think Mind Body gets, kind of mediocre grades from most of the people I talk to. So I think they have work to do to improve what they're offering. And yeah, I don't know. It felt like the financial guys made it work on a spreadsheet, but the for the industry, if you're a gym owner or a boutique owner, um, this doesn't really make sense to you.
Yeah.
Well, past piece, I can't really speak to.
I mean, it's exciting because this is the biggest valuation we've had of any company in our industry, right? So it's got a lot of attention, and I do like the leadership on both sides. I love
Yeah.
eGym, of course. I got to know Fritz a little bit. A great guy, very aware of what the opportunities are and where the challenges are, and yeah, so we'll see. So I'm overall I'm cheering for them. I hope they do well, and they raise a bunch of money, so that's cool.
Yeah, I mean, I think unless I'm mistaken, I thought ClassPass MindBody Playlist was looking at an IPO a year ago. And so, maybe that just wasn't in the cards. And they felt like, okay, well, we got to do something here. And this is the opportunity that presented itself. And I'm sure there's some strategy to take it public at some point.
Yeah. I mean, that's the most obvious thing when you look at this, right? It's like it seems to be setting up for an interesting IPO.
Yeah, but there's a lot of road to be traveled before that makes sense.
Yeah. Well, speaking of IPO, Strava. So this snuck by me. Thank you for throwing this out there, Alex. So yeah, so confidential S1 filed late 2025. They formally announced in February 2nd of 2026. Strava IPO. Looks like Goldman Sachs is leading. But what do we know here? What does this mean for the industry?
We know, but what I originally thought was after watching Xponential and I think some other public companies feeling stank on going public, I thought it was a good sign that they wanted to go public. I thought maybe this was the end, like we weren't going to see any other fitness companies go public because there seems to be some headwinds there. So I thought that was cool and a good sign to have, another fitness company take a swing at this public company situation. And it seems like Strava is a good one to do it. I mean, they have a lot of positive stuff going on in their company, and I'm a fan. I'm a user and a fan of their stuff. And I thought it was exciting. It seems like, I don't know, correct me if I'm wrong, Alex, but their goal was to try to potentially acquire some other companies and grow that way. But it all seems so early. But I thought it was exciting, and go local San Francisco based company.
There it is. Yeah. I've never actually used Strava, believe it or not, which is kind of odd. But I mean, I know a lot of people who live by it, swear by it. And I'm curious, like, do you think something like this, like Wall Street or the public will react and say this is a tech company or this is a fitness company?
Yeah.
It's a social network.
Or social.
Yeah. I think that's definitely yeah, I mean, it's definitely related to fitness, obviously, and athletics and sports, but I don't. Yeah, it's a tech. It's more tech. And they have a lot of members. I mean, 180 million.
Yeah, 180 million.
But I think only maybe 10% are paying.
Yeah, something like that.
Are you a paying member?
I pay because I actually want to, I like to see, well, these days as I'm getting older, my achievements are few and far between in terms of getting faster. It is, sometimes I'm like, why am I paying to see myself get like old and slow? But there's some features that you can't see as a free member that are fun, like you're sort of tracking your own progress on segments and I think there's some other, I think one of the other really amazing things they do is they have, you can like follow legitimate professional athletes who are tracking, I love to watch cycling, like I'm a cycling fan and mountain biking fan. So, when like the greatest cyclist to ever live, Tadej Pogačar, is just posting his daily rides and you can see what he's doing. Like there's some features that are fun and cool. I don't have time to spend a ton of time in there, but I'm a paying member and I think it's worth it. It's fun.
Yeah. Yeah, no, I definitely get benefit, and it's $80 or something a year. I don't even.
For a year, it's not.
It's really very affordable, and I think they're talking about AI. They are trying to provide some AI feedback on your workouts and your trends, and I think it's still early days in terms of the value of what they're providing, but they're working on it, and they have so much data that they can actually come up with some insights that are pretty that aren't available elsewhere.
Awesome. Well, last little section we have here is there's been a number of executive changes. So we have Tonal, Peloton, Expo, CrossFit. We've talked about a couple of these already. The Tonal one, not too long ago. So I did have Darren McDonald, the former CEO, now on this podcast last year. Really like the guy. He's only there for 17 months. So the new CEO is Todd Barty from El Catterton. I hope I'm saying that right. So yeah, coming from the PE side, what does that signal for you guys? First thoughts.
I'll punt it to you, Alex. I do not know.
Yeah, I mean, I think El Catterton's a big investor, and these private equity groups have operating partners who are executives, former CEOs, and yeah, I don't know. I don't have any intel on him. He comes not out of fitness, so again, it's a recurring theme that the executive pool in fitness, and and whether it's equipment or the gym business or boutique, but I think especially in equipment, like Peloton guys came out of Ford and Apple, and this guy's out of, I think he was at Dell, at Aquasana.
Didn't we have someone coming from like fast food too? I can't remember what we had, right? One of the CEOs came from fast food, I think. Taco Bell. Yeah. So you're like, okay.
Yeah.
The interesting one about this too is El Catterton is also involved in eGym and now Playlist. So it's like, are they building a connected fitness ecosystem, or they seem to be they're into it.
Active in fitness investing.
Yeah.
But the fact that these guys have had this guy Todd Barty is the fourth CEO in 3 years, right? Because you had the founder leave in 23, then you had, I think, a woman named Zell, and then you had McDonald, and now you have Barty. So that's a revolving door, and these are smart people, smart investors, and they don't seem to be able to figure out how to grow the business enough to where the shareholders are happy. Or it could have been that McDonald had some, there were some life issues that he was dealing with or whatever.
Yeah, who knows? Well, I love my Tonal, always have, always will. But I just don't know how many people have them, really. I don't know how much demand there is there. Well, we covered the Peloton one, so that was a CFO.
Yeah,
she's out. Xponential, the chief financial officer, John Malone out as well.
Malone,
yeah, 8 years.
Yeah,
I thought interesting, right? We lost Peloton and Xponential CFOs. What does that say?
And no permanent successor. So, but they did reiterate their guidance. So, sometimes when CEOs leave public companies, you're worried that there's some monkey business going on.
Interesting.
But in this case, I don't see any evidence of that, and they reaffirm their guidance. But given the history at Xponential and all the trouble, and the $40 million of recent settlements, I don't know if it's a coincidence or related, but he seemed like a really solid guy based on the earnings calls and 8-year track record. So give it the benefit of the doubt, and assume that he had a better opportunity, or he was burnt out or whatever. But it's I don't want to say it's a sinking ship. But, it's a lot of new CEOs and now a loss of a
taking on water. Yeah, a little bit.
What about CrossFit? You guys are
that's I saved this one for last because I know I'm sure Julia have plenty of opinions on what's going on here. Yeah, so Don Falls steps down. He was there for 4 years. I did get to interview him a couple years ago as well, and really enjoyed the conversation. It's just a tough one, right? I mean, CrossFit's a tough one. It says they still have over 13,000 affiliates. I don't know if that's correct or not. That seems a little high, but it's still up for sale, right? CrossFit's been for sale for a notable amount of time. They were talking about Masterjob buying it, but obviously his attention is elsewhere now with 24-hour fitness. So I don't know. What do you think, Juliet? What's the future of CrossFit look like? And are you going to be CEO?
Yeah. I need to, yes, that'd be great. I have to say that Don Falls stayed longer than I expected. I do think he's a really nice, I've had plenty of personal interactions with him. I think he's a really nice, thoughtful guy, and smart. And I think that is an extremely difficult organization to drop into and try to run, especially since it's been under financial pressure and, so many challenges over the last 5 years or 6 years since Greg Glassman left the company. So I give him major props, honestly, for staying that long. And I just do not know about a sale. Like, who is going to buy this company? That is, for me, speaking of head scratchers, like a complete head scratcher, especially because to me, the financial model is confused. And I still think the sort of difference between the games and the affiliates continues to cause weird challenges in the perception of the brand. They still really struggle. It seems like we've gone to a complete division in the world where people are either like, have a negative feeling of CrossFit or a positive feeling, and there's like literally no water in between those two feelings. So I have to think that's difficult. So I just think there are a ton of challenges. So a ton of challenges for whatever new CEO is going to come into the door. And I really don't know on a purchaser, like who's going to purchase CrossFit. But I do still think there's so much value in the organization. I think it's shown it has staying power, even though there's a High Rocks competitor and that's a big thing going on. I don't know. What do you guys think?
I mean, to your point, I always struggle to find where is the true value in CrossFit? Is it the brand? Is it the affiliate, right? Network? Is it the sport of fitness? Is it the education? Right? Because those are all revenue streams. I don't know how substantial either one is opposed to the other, but it's like, it's almost too diversified where it's like, who would buy it? Is it Nike going to buy it and make Nike CrossFit training centers and take the brand to the next level and, sponsor all the athletes and just do it, from a pure branding perspective? Or, is a really good operator going to come in and maybe, push this towards a franchise or something, similar to that, where it's like, okay, you beef up the affiliate model and you continue to grow the brick and mortar. Is the games the thing where they just sell that off to somebody else and let High Rocks buy it and take that over? Like, I don't know. Or does it just get cut up into pieces and sold that way? I don't know, but that's where I always struggle is like, where's the real value in CrossFit? And people are pounding on their computer right now, being like, it's a community, Eric, that's the value. I'm like, oh, well, okay. But how do you monetize that really? And that's more of a brand thing. Yeah. So I don't know. I look at this. I don't think I'd want that job because
I will say too, though, that one thing I find interesting in, because now we've talked about this over the last year and a half or so about how there has been, in part because of the longevity community, this big push towards lifting weights. More and more people are realizing the importance of weightlifting and strength training in their routine. And still to this day, no other modality has emerged, in my opinion, that does a better job of that than CrossFit. Like if I have a 52-year-old mom who's like, I have osteopenia and I realize I've just been running and only doing cardio and I now realize I need to lift weights, what should I do? I mean, hands down, I would refer them to a CrossFit before any other gym in my area because I know that they're actually going to learn how to lift weights correctly. It's going to be done in a coached environment, not free form in some Globo gym. They're actually going to learn how to do, barbell movements and some actual strength training. That's actual strength training versus like moving weights through air, which is what a lot of strength training is. So there's something in the staying power of that, I think. But again, how do you monetize that?
Well, I think with that, and here's to that scenario, Juliet, which CrossFit affiliate would you refer them to? Because the quality amongst affiliates is so drastically different, and the experience that one has if they walk into one that's poorly run with shitty coaching is very different one than if they went into San Francisco CrossFit and had the best, right? So it's like where do you go from there?
And that's always another, right. I think this is always, because I do think there's so much value in the affiliates, but how do they, I don't know, there'd probably be extreme revolt over a franchise model, but how can they, I still think most, I would say like 75% of CrossFits are probably running a good show and a good program and have good coaches who care. And then, but it is, I will say I do my research before I refer people. So yes, I don't just say go to any CrossFit. I am very careful. I look, I check their website, I look at their programming, I do some things to evaluate, is this place legit? Not everybody can do that.
No, very few. Alex, what's your take on not being in the CrossFit world?
I think Eric and Juliet should be co-CEOs, and I think you guys have all what I've heard. It makes a lot of sense from the but you guys are insiders to a lot more than I am. But I've always, I thought the foundational kind of the quality of the fitness product was not an issue. I think it's a lot of, maybe too many injuries and people trying to do too much. And so, that maybe has to be addressed. It's a hardcore brand. So you have to soften the brand a little bit if you want to appeal to a broader audience. And then the fact that they would sell a license to anybody, anywhere, as long as you got your certifications, was just chaos, right? I mean, to me.
It was chaos.
Yeah.
Beautiful in some ways. Yeah.
It was chaos. Beautiful, there were literally two gyms there'd be two CrossFit gyms next to each other in the same shopping mall. You're like, okay, chaos.
Yeah. I mean, I get
to grab a 3-iron and hit 3 of them.
Darwinism and survival of the fittest is a great system. Not for gyms.
Yeah, and that was literally Greg Glassman's perspective, by the way. I mean, he really was like, the cream's going to rise to the top, so we aren't, if we put two gyms next to each other, one of them's going to win, and that was horrible. I mean, we all I think we all had this low level of fear all the time, running our business, that is, in any day, someone would literally just open up shop next door, and then because customers are fickle and everybody likes the new, cool, shiny object, they're going to bump over, right? So that was total chaos, complete chaos. I did, by the way, I think I mentioned this on a prior episode, but I was in a meeting with Don Falls, and I still believe this to be true, and probably true about all these fitness companies, is apart from appointing Eric and I co-CEOs, which would be very fun, by the way, Eric. I would happily take that job.
At least for a little while. Yeah.
Yeah. I did ask Don why they don't ever have, and this I think goes across all these fitness companies, why they don't have any insiders on their board. It's all just financial dudes that sit on their board without any insiders. And I've always thought that was weird. And I suggested myself as a person, but I also said, if not me, a Jason Khalipa, or there's a number of people who I think are
Dan Waimura would be great.
Yeah. I mean, I could literally think of 15 people who could fit that role. And I think would do such a good job of advising that board, because it is such a, the community piece of it is so, everyone's obsessed with it. And if you don't have someone on the board who really gets the community in that organization, I don't see how they can operate. So, I hope they do at least that with whatever new they need to bring someone onto their board who is a CrossFit insider. That would really help, I think, guide the organization, to me.
Well, there's no shortage of passion within the CrossFit community. If you ever hang out in the CrossFit Affiliates Facebook group, buckle up. It's an experience. Those people have a lot of opinions. Well, I think that's just about a wrap, you guys. I do believe this is our longest one yet. We had so much to cover, and I appreciate everyone who stuck through and listened to the whole thing. There was a lot to noodle on here with our industry. Any closing thoughts for Q1 2026, you guys? Juliet, anything come to mind?
Overall, I feel like it, continues to be overall positive for our industry. Despite my sort of mixed feelings about the eGym merger, but I think the Strava IPO is very exciting. It's really fun to see Garmin and Lifetime continue to really run solid, amazing businesses, and super curious to see what Expo and Peloton are going to do. But, overall, I feel like industry-wide, there's a lot of good news. There's a lot of positives.
Alex?
Yeah, I like that positive spin on this quarter, because if you just look at stock prices of basically the companies we're covering, other than Garmin and Lifetime to some degree, but yeah, you would think there was blood in the street, and overall the fitness industry has a lot of really healthy, successful, and growing companies. And I just invested in, for full disclosure, in a company called Yoga Joint in the New York franchise that is opening a couple units this year. And the quality of the founder here, Adam Shane, I don't know if you've heard his name, but he was a colleague of mine at TSI for years, and then went on to Equinox, and then Barry's was the main chief development officer at Barry's, and now he's rolling out this yoga hit concept, infrared, and so as long as we have founders like that, entrepreneurs like that coming, with new concepts, I'm gonna, I'll be bullish on the industry. I think we have plenty of them. So I'm overall really bullish, and I'm hoping for some IPOs, obviously, selfishly, so we have something to talk about on this show.
Yeah. It's coming. I think it's coming.
Okay.
Yeah. We're gonna lose one though. We're gonna lose one. I think we're gonna lose one.
We will.
Yeah.
Well, there'll be new ones. Yeah. Well, I'll double down on all that. And, I have this really great concept, Alex, where it's a shower where it's red light and vitamin D lamps with hydrogen water that comes down inside of a hyperbaric chamber. So I think that's going to be my next thing. I'll put that on a napkin and I'll send it over to you. Yeah. But I think we have a lot of tailwinds within the industry right now. And overall, I think we're seeing in real time the convergence of fitness and health and wellness and medicine, which is really cool. Like that bridge, that's the most exciting thing to me, because I've been talking about for so long, is how we're starting to finally integrate and communicate with the medical community. And a lot of people are bringing medical services under the roof, right, of their gyms. And I'm really fascinated with those models, from, Ramphone Training System. I just released a podcast with him, to Monarch Athletic Clubs, to Carbon World Health. Like all these cool things are popping up now, and that gets me really excited. So, yeah, I mean, we can talk a little bit of doomsday when it comes to the public markets, but overall, I think our industry is doing some really, really cool shit. So let's keep it up, folks.
All right.
Agreed.
Thank you, guys.
Thank you both. Thank you. Always a pleasure.
Yeah.